Is Walmart an excellent defensive stock to own right now? I know a lot of economies in the world are expecting a significant slowdown in growth as central banks have begun raising interest rates and inflation is pinching consumer budgets worldwide. And so they're looking to spend their money where they get more bang for their buck, and Walmart could be a beneficiary of that trend. So, does that make it an excellent defensive stock to buy? Maybe. Let's answer that question in this video using several different metrics, and I'll give you the answer by the end of this video. So interestingly, Walmart stock held up relatively well in 2022. The stock was down only 2%, where the broader S&P 500 was down nearly 20%, and the Nasdaq index was down nearly 30%. So Walmart was a relative outperformer in 2022. Could that continue in 2023? Let's consider that. So first thing I'm going to look at is Walmart's revenue growth, and for years, between I would say 2010 and 2016, the company was losing market share. Amazon was taking a lot of sales that were otherwise previously going to Walmart, but the company revamped its business. It made solid investments in its e-commerce business. It made great investments more recently in its same-day delivery programs, the buy online, pick up in store. And so now it's able to leverage its brick and mortar presence to use it as an advantage, whereas it was a disadvantage, I would say, between, let's say, 2010 and 2015. It was a disadvantage because it had all those high costs, high expenses to maintain those stores, and it wasn't attracting any customer. It wasn't attracting enough customers to justify those massive expenses to maintain. Nowadays, in the last 2 or 3 to 4 years, I would say that Walmart, and for that matter Target even, has learned how to use their brick and mortar presence as an advantage against Amazon, and they've kind of stabilized those losses, and you could see revenue growth accelerated. It bottomed in 2016, and then Walmart has been steadily adding quarterly revenue growth at an accelerating rate at 8.7%, the highest in its recent past in the most recent quarter. So it's doing reasonably well. Next thing I want to look at is Walmart's operating income. And while its revenue growth has been accelerating, I cannot say the same for its operating income, which has been on a downward trend ever since 2014. Some of that can be explained by its investments in e-commerce. Of course, it's more expensive for Walmart to make a sale online than it is for Walmart to make a sale in its stores, right? Because it has to ship that item to the customer, and it offers that item at the same price as it does in the store. And so it's just going to cost Walmart that much more to fulfill those items from its online sales. Now, to partially control for that cost, Walmart has a minimum order. Last I checked, that minimum order was $35 for free shipping. So at least it spreads out that cost over $35 order. Still, if that $35 was spent inside a Walmart store, Walmart would generate a higher profit. And so that's what it's working to alleviate, is some of those shipping and handling expenses. And one way it's doing that, and successfully I might add, is by rolling out its same day services. When customers choose to buy online and pick up in store, that's an incredibly profitable transaction for Walmart, because now it saves money on cashiers, right? Because the person is not going inside the store. It reduces the amount of theft that happens inside Walmart, because sadly, a percentage of customers that visit Walmart maybe pay for four things but take home five things, right? Shrinkage is something that many brick and mortar retailers have been complaining about recently. But if the customer is shopping online, Walmart doesn't have to worry about that so much. So it does have a plan to alleviate these drops in operating income. So far, they have been successful. You could see that trend reverse. In its operating income bottomed in 2018 and has been rising. You can ignore this most recent crash in operating income. I will speak more to this when I go and discuss inventories in a later slide. The next thing I want to show you is Walmart's cash flow from operations, and it's been relatively stable. I would say slightly upward trending. If we look at the bottoms here, has been going higher. Walmart's been able to leverage its fixed investments, right? Some of the expenses for its brick and mortar stores are non-cash expense like depreciation, and so that's able to generate cash flow from operations even while operating profitability has been falling over the years. Finally, here's the primary key for those interested in investing in Walmart stock to pay attention to is the incredible rise in inventories. We see here from the bottom in 2020, late in 2020 to now, Walmart's inventories are higher than they've ever been, 64.7 billion in its most recent quarter, way higher than any recent peak, and that's due to the pandemic supply chain disruptions. Walmart overinvested in inventory to make sure that it had what customers wanted and not be out of stock. And this is what caused its operating income to crash in its most recent quarter. It's starting to offer a lot of discounts, a lot of promotions to get rid of some of this excess in inventory, as well as Target and some of its competitors. They've all begun to offer more discounts and promotions. Whereas in 2020 and 2021, Walmart, Target, Home Depot, Nike, all of these retailers, Macy's, Nordstrom, you can go on and on with the list. They had record amounts of full price sale through because whatever you had in stock, customers were buying. You didn't need to discount. That story has reversed now, and those discounts are extending. However, it's not as bad as I expected it to be. The discounts are, if you shop at Walmart and if you shop at Target, you will have noticed some discounts. But even after you notice the discounts, you're not thinking like, oh, wow, this is an incredible deal, right? They might be like 20% off or 25% off an item that was already expensive. So it's not like the price markdowns are as high as I thought they might need to be to get rid of the inventory. It's been there, but not as bad as I expected. Finally, let's look at Walmart's valuation. It's trading at a forward PE ratio of 23.88. It's on the more expensive side of its recent price trends going back to early 2021. And given that Walmart faces these inventory headwinds, that it's going to need to continue discounting, marking down inventory to get rid of this excess, and given that consumers are opting to spend more money on away from home experiences and less money on things like flat screen TVs and computers, this headwind is going to persist into 2023. And so for that reason, I would say Walmart is not a good defensive stock to buy right now in 2023. All right, so that's all I've got for this video. Thank you for watching. I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.